This is Super Investors and the Art of Worldly Wisdom. I'm Jesse Felder.
Object to the test!
Sound on in April of 142!
Warren Buffett.
Carl Icahn.
John Templeton.
Buy low, sell high. Fear, that's the other guy's problem.
Dan Druckenmiller.
George Soros.
Paul Tudor Jones.
Peter Lynch.
I wonder why fund managers can't beat the S&P 500? Because they're sheep. And sheep get slaughtered.
My guest for this episode is Bill White. Bill started his career at the Bank of England. He eventually became the chief economist at the BIS, and today he is the chairman of the Economic and Development Review Committee at the OECD. Last fall, Bill was awarded the Adam Smith Prize, the highest prize of the U.S. National Association of Business Economists. And as he accepted that award, he gave a speech he titled Ultra Easy Money Digging the Hole Deeper. Now, I'm not going to ruin the surprise for you by telling you what he said in this speech, though you probably have a pretty good idea. And we cover a lot of it in this conversation. But there are two things about this speech that I found very encouraging and actually inspiring. First, that somebody like Bill, in such a prominent place in the world of economics, had the courage to question these extreme monetary policies we've witnessed over the past decade. And two, that a prominent economics organization would see fit to award him for this courage. So I'm really honored and excited to have Bill on the show. In this conversation, we discuss where Bill's contrarian economic philosophy comes from, and how it leads him to worry a bit more about the undesired side effects of experimental monetary policy. We also talk about the possible end games of such policies. So without further ado, I really hope you enjoy my conversation with Bill White. Bill, welcome to the show. Thank you so much for being here. It's really an honor for me to have this opportunity to pick your brain and share your wisdom with my audience. Welcome.
Well, it's a great pleasure to be here. Thank you very much for the invitation.
Yes, very glad to have you. What the first thing I'm curious to know about is really what first got you interested in economics. Where did you get the bug in the first place?
Total serendipity. I got a scholar. I was always interested in politics, and to be honest, it was my intention from the time of being a teenager to go into politics. And I came from a family that didn't have an awful lot of money. So to go to university, I wanted to do it on scholarship and managed to get one. But it was a university where they only had a joint course in politics, and it was a joint course in economics and political science. And so the economics just sort of was there. But it wasn't my primary source of interest, which was the politics and the associated philosophy, I guess. And then one thing led to another, and I just got more and more interested in the economic aspects of things. And that's when I decided, again following the money, to take up a scholarship at the University of Manchester to do an MSc and a PhD. In economics. So that's basically how I got into it. It wasn't a matter of intention. It just sort of grew on me over time.
Gotcha. So it started out as a path, political path or political interest, and kind of morphed into economics. Where exactly did you study?
Well, I did my first degree at a place in Windsor, Ontario. Which was called the University of Windsor. Previously, it was a Catholic college, but then sort of gradually evolved into a secular one. And then I did my PhD under a Commonwealth scholarship at the University of Manchester in England.
Gotcha. And so, your economics, economic views. I can't think of a word better than contrarian. There's, popular economic views, kind of espoused by central bankers these days. Yours are not, I guess, along those lines. Where is there something about your schooling that helped you come to different conclusions and viewpoints?
Yeah, I think really right from the earliest days of my graduate work, I was very sort of skeptical of, as it were, the received theory. And I was much influenced by a book. Maybe you will remember or have heard about it. Burton Malkiel's Random Walk Down Wall Street.
Of course, yeah.
And what I really... Do you remember that? Maybe before your time, probably.
Oh, no. It's I think it's one of the more popular books, that lays the foundation for a lot of the passive investing and whatnot that we're seeing today.
Yeah. Well, anyway, the basic message that I took away, as I recall, was that you don't just sort of read the stuff that tells you what people ought to do, the theory, that you really do have to get down in the trenches and find out what people actually do, because there could be a difference. And so when I was working on my PhD, I spent a lot of time in London talking to people at big financial firms. My thesis was on, it was called The Authorities in the UK Gilt-Edged Market. And by the authorities, we meant some combination of the UK Treasury and the Bank of England, because central bank independence hadn't been invented in those days. So it was the authorities and the gilt-edged market. And that brought in all sorts of questions about debt management, financial stability, monetary policy, et cetera, et cetera. But I had chapters about portfolio practices on the part of the banks, the insurance companies, the discount houses, I think. But the central point was that there was always a distinction in my mind between what the theory said people were doing and what their actual practices indicated they were actually doing. So that's sort of the starting point, to really raise questions. And then so many other things happened in the course of my life to sort of cement this, this questioning attitude. Like when I went to the Bank of Canada, for example, I remember we started off with a fixed exchange rate system in the late 1960s and thought that was the way monetary policy should be managed. Turned out to be a disastrous assumption because it just meant that the Bank of Canada was importing into Canada all of the big inflation in the United States. Remember, with Vietnam and the Great Society and all that stuff. So we decided that wasn't a good idea, and then we started focusing in on the natural rate of unemployment as a guide for monetary policy, only to find that our estimates of what we thought the NAIRU was actually wildly different from what the reality was, because there were big changes in the unemployment insurance regime that actually raised the natural rate. So we made a mistake again. And then we started targeting the monetary aggregates. And that whole sort of regime was based on the assumption of the stability of the demand for money. And of course, that proved to be a total mirage because people invented things like sweep accounts, which meant that the demand for M1 was actually a lot less than we'd originally anticipated, so we made another mistake. So, and this sort of went on and on. And I guess what I sort of came to the conclusion, and this is more sort of a philosophical thing than it is a thing to do with economics, is that just because people say it's true doesn't mean it is. And I guess I've kept up that kind of view of the world, not just in economics, but with respect to a lot of other things as well. Science proceeds on the basis of empirical analysis, right? You've got an hypothesis, then you want to test it. And if it fails the test, well, then you have to move on. And I think my whole career really has been based on having to say, I'm terribly sorry, it seemed like a good idea at the time. But, right. Putting the theory up against the theory turned out to be wrong. So that's sort of the starting point, it seems to me. It's a skepticism that goes back a very, very long way.
Well, interesting. That I think of immediately when you talked about actually looking at what's happening in the real world. It's kind of a scuttlebutt approach to economics. Phil Fisher was one of Warren Buffett's idols, and he kind of talked about the scuttlebutt as part of his investment process, which was not just looking at the numbers and looking at the valuations of companies on paper. It was actually visiting the companies and visiting the stores and products and seeing how consumers may or may not be using them or adapting to them. That's fascinating. So do you think that's where most economists kind of fall down, is that they're too wedded to theory and don't pay enough attention to how it actually works in the real world?
Yeah, I think this is really the case, and this sort of what's the word? This applies in all realms of human endeavor. That people get sets of beliefs and they work on the basis of that set of beliefs. And they find it very hard to jettison that set of beliefs. And if you go back even to the 1960s and Thomas Kuhn, you remember The Structure of Scientific Revolutions, where the whole book is essentially about that and about how hard it is to get paradigm shifts. And I think in economics, we're seeing this really in an exaggerated kind of way. At least at the moment. And I find it sort of a bit funny because, in economics, there have been, and the conduct of monetary policy, there have been in the past, or there has been, a reasonable willingness of people to say, it doesn't work, this way of doing it doesn't work, we have to think again. This time around, the rigidity of the belief system is particularly noticeable, and I'm sort of wondering. What's his name? Kahneman makes this point, I think, in Thinking Fast and Slow, that when people are really shocked by something that happens in an unexpected way that conflicts with their belief system, Kahneman says that they don't, in fact, go back, step one and question the belief system. He contends that they retreat more deeply into it because it's all they've got in the face of this shocking new set of facts. And it may well be that after the Great Moderation, that what happened subsequently was so shocking that maybe what we're observing is just an example of that. But certainly the central bankers, when you think about what they've been up to, it really, since the crisis, what they've done, although it's been done in unconventional ways, what they've done is premised on two fundamental beliefs that were the same after the crisis broke as they were before the crisis broke. And that is that whenever you get a slowdown in economic activity, the problem is deficient aggregate demand, and that monetary policy can back that demand in again without there being any important undesirable side effects. So that business about monetary policy will work and it won't have any undesirable side effects, that's basically been the hallmark of both the pre-crisis and the post-crisis monetary policy reaction. And just from a common sense perspective, it strikes me that this is all very odd, because one would have thought that when the crisis happened, when theory said it couldn't, and its memory lingered on for years, when theory said there should have been a rapid readjustment back to full employment, that people would have started to think again, but they didn't. It's been essentially business as usual. So I just find the whole thing very odd.
It is very odd, and I think, honestly, the average person, when you kind of explain to them, what's happened over the past 20 years with monetary policy, it's pretty obvious, these undesired side effects that you've talked about. Massive, debt creation and financial bubbles and these things, and very little to show for it in the way of, economic benefits. That's purely, I think, just a function of central bankers who are living in their own world of reality, but this kind of begs the question. So they have decided to treat every recession over the last 20 years with a monetary policy that encourages greater debt creation. Like you said, it's pretty obvious that this cannot be done indefinitely, and it's also pretty obvious that, especially this cycle, we've had a very long expansion cycle since 2009-10, but also the weakest expansion on record. Why? It seems obvious to me that this extreme monetary policy is not having the desired effect, which would be a self-sustaining recovery. What are your? Why do you think? Do you think it's just a psychological phenomenon that they refuse to accept that reality, or something else going on?
Well, I think here's the short answer. I don't know. On the one hand, it could well be that the only factor at play is the maintenance of the false beliefs that I just spoke about. The second thing, however, and maybe both of them are going on at the same time, is the central bankers sort of did the right thing in 2007 through 2009, it seemed to me. Remember, the thing started off with sort of totally dysfunctional financial markets, and I think the central bank stepped into that gap and sort of tried to sort things out as a matter of encouraging financial stability in exactly the right way. But once they were into it, there was a lot of pressure to continue doing it, pressure arising from other sources. And I guess what I mean by that is that here we had the initial use of monetary policy to try to stabilize financial markets and to stabilize the economic system. And then subsequently, of course, we had this strong fiscal retrenchment, starting around 2010 and onwards. In addition, you had a lot of efforts being made to improve the regulatory framework, which I think likely had the implications of slowing down bank credit or credit growth and aggregate demand. So you had the fiscal thing and the regulatory thing moving in the direction of tightening up, and monetary policy, which had already been eased for this other purpose, financial stability, found itself as the only game in town. And they basically felt impelled, it seemed to me, to continue doing what they had previously been doing, but for a totally different purpose than what they'd originally done it for. Okay, so originally it was all about financial stability. And then I think starting with Bernanke's speech in 2010, I think to the New York Economics Club, where the focus was all on aggregate demand, raising asset prices, the trickle-down thing, lifting all boats. But it was a different objective of policy. It became a different objective for policy at that point. And so are the central bankers doing it because they truly believe that it will work and the side effects are inconsequential? Or have they gotten sucked into a position where they really had no choice but to continue doing what they're doing? The answer is I don't know. I suspect it's a combination of the two.
Okay, and let's just talk about some of the. You've written that you're concerned about these undesired side effects. What specifically are you referring to?
Well, there is a long literature out there, right, about, Vixel basically came out at the beginning, it's over 100 years ago, and said that if you lower interest rates below the natural rate of interest, that you will get inflation. And that was an undesired side effect, so I guess Vixel's conclusion was don't do it. But subsequently, there were all sorts of people who came along and said, well, that's not the only thing you have to worry about. We had Hayek, for example, back in the 1930s, talking about real misallocations of resources. You had, what's his name, Richard Koo talking about balance sheet recessions, and that too easy monetary policies would lead to debt buildups that would then subsequently have to be reversed and would be recessionary for a long period of time. You had Hyminsky and all of this stuff about stability breeds instability. People just get, what's the word? When things are okay, people say it's going to continue to be okay, even though there's problems building up underneath the surface. So there's a long sort of academic history of concerns about these matters. I guess most recently, and this is sort of some combination of the BIS when I was there as the economic advisor, and the stuff that I've been saying more recently, is that the side effects are of a very varied nature. One of them, I think, the sort of growing evidence, and this is sort of Hayekian in spirit, that you get big misallocations in the boom period, okay, that's generated by the easy money. You get misallocations that I think in recent years have forced too many resources into retail, particularly in the United States, but retail, banking, commodities for a long period of time. So you get these misallocations, and then, of course, then along comes the bust, and in the bust, the recourse to easy money again. But this is just an invitation to the banks and to others to sort of evergreen the loans. Ben Bernanke wrote something about this in the 1980s. The basic message is one of, if I don't know my client is solvent, and I, the banker, don't know whether I'm solvent, the idea that I'm going to blow the whistle on them, there's a very strong incentive to just evergreen the loan, not take the hit, because maybe, like Mr. Macabre, maybe things will work out for my client, and I know I can't take the hit as a banker because I don't have enough capital. So the fallback position is just roll it over. And then you've got all sorts of competition that ought to be dead that's still alive, sort of like the zombies dragging the good companies down into the grave with them. So that's one element in terms of, misallocations and lower potential growth. Another one that worries me, and it's closely related to the financial instability side, is that if you've got a world in which market prices are basically determined by the central bank, and the price discovery process has disappeared, and the correlations have all gone, between the asset classes, the rates of return have gone very high. Well, where's the value in value investing, and where's the value, for that matter, in diversification? And so you get less of these things, and I tend to think that those things are good for good credit allocation and for potential and for fostering faster potential growth going forward. So those are the sorts of things that one worries about in terms of, really underlying negative effects on potential growth going forward. And then you've got all the other sort of financial sector side problems that people have wrestled with, perhaps both in the US and in Europe, which is, narrowing the spreads. both the credit spreads and the term spreads. And so the insurance companies and the pension funds are having a tougher and tougher time to stay afloat. The banks, who didn't complain about it for a surprisingly long period of time, but then started to realize that their margins were getting squeezed too. So that's a problem on the financial side. Maybe these policies will give you more financial instability as opposed to less financial instability. And I think there's a very good case to be made that not only do you sort of, as it were, set the prices falsely, but many of the prices get set too high. So you've got so much liquidity being created by the central bank that it drives up the prices of virtually everything. So you sit there at the moment, it's gotten a little better recently, but, trillions of dollars worth of quote-unquote riskless bond yields in negative territory. And you've got these high-yield spreads that have been squeezed. You've got, the VIX at very, very low levels, the same sort of rationale. And so all of these things, it seems to me, are potentially reversible. And then the question becomes, well, what'll be the fallout? And the answer is we don't know, but it's likely to be unpleasant. So there's all of these sort of undesirable side effects that I think are materially important. Some things that are not sort of directly related to the economic. Well, it's hard to tell. I mean, everything's related to everything. But what I was going to say was that, I think wealth distribution has been skewed by what's gone on here. And I wouldn't put monetary policy and high prices of financial assets owned by richer people number one in the driver's seat for the increase in both income and wealth inequality. But we've already got a big problem in virtually every country you can think of in terms of rising inequality. And I think monetary policy has made it worse. And so that's not a good thing. Then we got all these other issues about central bank independence and whatever. And I think that the way in which monetary policy has been conducted has left the central banks very exposed. It's left them exposed with respect to their own internal capital. What happens if the rates go up significantly in a lot of the assets that the Fed has bought in, and the same in other countries. I mean, the ECB and Bank of England, etc., Bank of Japan. I think there's a lot of unintended side effects, and one could say, well, look, if it's only a year or two, the benefits of these policies outweigh the costs. But what I'm concerned about now is that after 9 years of this stuff, and it has been it started in 2007, right? So almost 10 years. 10 years is a long time. And the way that I've expressed it sometimes is, if you think that the efficiency of monetary policy is declining over time, that the bang for the buck is getting less and less in terms of aggregate demand increases. And if you think that the costs associated with the policy, all of these side effects that I've just been talking about, are going up over time, and we got one function sloping down with time and one function sloping up with time, and at a certain point the two paths cross, and you basically say we're doing more harm than good, and we should stop doing it. And I guess reasonable men and women can disagree about where that crossover point comes. But I guess after 10 years, you'd at least have to be sort of thinking about the possibility that we might have gone past the due date.
Absolutely. And we talk about these unintended or undesired side effects. What about the, intended effects? And do you think central banks should have to demonstrate some type of efficacy of these policies?
Well, it was the great Keynes who, in the general theory, I think in chapter 13, said, if I get the quote right, if we are tempted to assert that money is the liquid that activates the system, we would do well to remember that there are many slips twixt the cup and the lip. And he then goes on to point out how all of the elements in the transmission mechanism that would lead eventually to an increase in demand might not work. And I think he was spot on. And you will recall, too, that, I mean, the treatise on money basically started off by saying, well, concluded, use these extraordinary monetary instruments, and they will work. But that was 1931, and by 1936, Keynes himself had said, this is not the right way to do it, and we have to turn to something else. And, of course, that something else was fiscal policy and infrastructure and blah, blah, blah. So there's, again, a kind of precedent here in the history of economic thought that, you know, maybe it might not work. Now, why might it not work? Well, for a starter, I guess, because monetary policy, in whatever form you think about it, conventional or unconventional, is trying to induce people to move their spending forward in time, right? Because the discount rate is now lower than it was previously. So what you would have spent later, you want to spend it sooner. And this is what my colleagues at the Fed always used to refer to, and very positively, as intertemporal allocation. And this was a good thing. But while they always talked about the more spending today as a good thing, they never spoke about the fact that the intertemporal allocation, by definition, means what you spend today, you can't spend tomorrow. Okay? But they never talked about that. But that's precisely what happens. Or to put it another way, if you encourage people to build up debts that have to be repaid, okay, and the debts are the counterpart to the spending, well then what is a stimulus today is a de-stimulus tomorrow. And so I think there's a lot of that going on. And I mean, as you're well aware, I mean, at the global level now, I think the Institute for International Finance quite recently came out with a study, and I think what they said was that since 2010 or 2007, from 2007 to 2017, the overall level of global debt, that is to say governments, households, and corporates, is up by $70 trillion. And a very large chunk of that now is in the emerging market economies. But the central point is that the debt levels have gone up very, very substantially. And it's those debt levels, or as Chairman Greenspan would have referred to them, the headwinds, that eventually kick in and, as it were, stop your monetary policy from producing the sustainable increase in aggregate demand that you'd anticipated. So after 10 years of doing this, you know, one wouldn't be surprised to find not only has there been sort of a weak response to the policy, but that we've been left with a still greater headwind of debt that makes many of us feel a bit worried about where we go from here. So that's a sort of a general point. I think a second thing, too, about this policy is that what they have done, the central banks, has been so unusual. Okay, they've been making this stuff up as they go along, but it's so unusual that I think there must be a lot of people out there who basically say, this is so unusual and scary that it implies that there's something bad happening. And my reaction is I'm just going to hunker down. You know, when you're not sure about what's going on in the world and there's profound uncertainty about what's happening, to which this policy sort of gives some support because it's so unconventional. Well, if people are just hunkering down, then again you're going to get less of a response. And you can go through all the different elements. I mean, the consumption, the investment, whatever, and you can come up with a whole list of other things that lead to the policy being less effective. But I think that's probably a long enough list for the moment.
Okay. Is that now thinking about, the Fed talking about unwinding their balance sheet now? I mean, do you think these are, the efficacy of the policy waning and potentially creating uncertainty? And that's an interesting point that I don't think I've heard somebody make. Do you think that's kind of what is behind their thinking in this regard, or do you think they just want to kind of create some firepower for the next, some dry powder for the next downturn?
Well, again, I mean, unless I was sort of sitting in there at the FOMC meetings, and it's really hard to say what it is that motivates people. Mm-hmm. Given Janet Yellen's background in particular as a labor economist, and I'm going out on a limb here, I wouldn't be at all surprised that she's taking a relatively conventional view of the inflationary process, and that what the Fed is now saying is that you're so close to full employment, although I know there's 14 different measures of it, but that you're close enough now, and the momentum is strong enough now, momentum of growth, that even though we don't see the inflationary pressures, it's coming down the line, and that if they don't want to be behind the curve, that they have to move sooner as opposed to later. I think there's a strong element of I think there's likely to be a strong element of that in the way that people think about it. I've read a couple of pieces, but it's all sort of secondhand stuff, that in fact there is a growing sense of concern about some of the side effects that I mentioned earlier, although their concerns would be nowhere near as great as mine have been for these many years right now. But it may be that sort of looking at some of these financial variables are starting, and the debt levels, and that they're starting to say to themselves, I think we've got to have some concerns to sort of head this off.
Well, we've seen, the conventional, I think, wisdom when these policies began was that, if you extend them too long, you will see inflation. And we've seen, obviously, massive inflation in the prices of, financial assets. But we haven't seen traditional inflation. And so this is something, I think, that people are trying to understand is why haven't we seen inflation, and why might we see it in the future? I know this is something that you've been concerned about.
Well, it's sort of interesting. It's a bit of a reprise, of the 2008 thing. Like, what we said at the time at the BIS was, and I actually wrote a couple of papers about this, technical papers. Why is global inflation so low leading up to 2008? I mean, inflation was very low. This crisis was not preceded by sort of a major inflationary upswing. And I guess the answer that I came up with was that the reintroduction of China and Slovakia and all these sort of command and control economies back into the global trading system basically constituted a very significant positive supply side shock. And add into that the baby boomers going through in the advanced market economies. And what you had was a significant positive supply side shock. At the same time, demand was relatively weak. And I think there's more work that needs to be done on this. One part of the hypothesis, I've heard Charles Goodhart talk about this, is that because labor income was so weak and wages, because it was an oversupply of labor, if you want to put it that way, in that earlier period, that wage growth was severely constrained. That accounted for the declining labor share in terms of total factor income. And so, therefore, the workers didn't have the wherewithal, as it were, for very strong consumption in many out of income by the same set of arguments, and this is where I think we need more work. Even though the corporate profits were very high leading into the crisis, I think the conventional wisdom would be that if the profits were high, that the accelerator would have led to still more investment spending, but it didn't. And the counter argument is, well, when the profits are that high, who needs to invest still more to keep ahead of your competitors? Because we're making lots of money. And then you add in on the investment side the sort of the investment collapse after after the Japanese bubble, Southeast Asia, German reunification, the TTM thing. So there are a whole series of negative shocks to investment. Bottom line, supplies moved out, demands moved down, prices are very, very weak, and monetary policy moves to back in the demand that's missing. And so we wound up in that period, the Great Moderation, with very fast growth, but very low inflation and very low real interest rates. And then the whole thing collapsed. Now, what I'm worried about at the moment is that we may have the same kind of thing going on, the increases in capacity, particularly in China, but more broadly through value-added chains and all that sort of stuff, may in fact be giving a continuing disinflationary impetus to the global economy. And that inflation, in fact, constitutes, at least for us in the advanced market economies, another positive supply-side shock. And if that's the case, then leaning against it with still more credit growth is not the right response. The BIS annual report this year, and I continue to, even though I don't write it, I continue to read it with great interest. They've got a big section in there, and Claudio Borio talked about it a lot at the annual general meeting this year, about the way in which if you take a traditional Phillips curve, whether a wage Phillips or a price Phillips curve, the coefficient on the gap, the domestic gap, has been going down and down in virtually every country. And the coefficient on the global gap has been going up in virtually every country. And so what it really implies is that it's these global forces now that are having more of an impact than they did before. So if that's the case, it really calls, it seems to me, for a much broader discussion about how we cooperate, coordinate, I'm not sure what, at the global level to try to deal with problems that really have their origins at the global level. But of course, that's not the way people are thinking about it. Everything's still being done totally at the national level. So that's a source of real concern to me, that we are collectively making the same mistake. We've collectively been making the same mistake in recent years that we made prior to the crisis, which is that we're responding to a positive supply side shock with credit creation, and that's just simply going to make the problems worse, not better.
And so we've built up a ton of debt over this time period, and monetary policy is becoming less effective. How does this, in your view, what do you think is the most likely end game for this process? Right, it can only go so far, but before you've taken on as much debt as you can possibly sustain. How do you see this evolving? There are alternative scenarios, clearly, and how monetary policy reacts to those different scenarios, okay, is another element of uncertainty. Do you follow me? That just sort of the inherent dynamics of the situation in which we find ourselves are uncertain, and how monetary policy will react to those unfolding circumstances is also uncertain. But where do we go from here? Before we talk about monetary policy, two broad stories, it seems to me. The happy
Not sure whether to start with a happy story or the sad story. Let's start with a happy story. The happy story is that monetary policy has now got us to a point of It's got a momentum to the recovery that will be self-sustaining, and that the growth rates will be faster than the percentage point increase in the interest rates. So that you'd have a world in which the global economies are recovering, and debt ratios are basically going down because GDP is growing faster than the debt service is. And that could happen. I mean, it's interesting, for example, at the moment. I was just looking at the IMF. The IMF just came out with a revised forecast. And basically, global growth, I think, is going to be, they for 2017 will be about 3.5 percentage points, with the US and the UK slowing down a bit from earlier forecasts, but China, Japan, and China stronger than earlier forecasts. But the central thing about it is that this is the first time, I think, in 9 years, where the forecast as of the middle of the year, okay, so 2017 for 2017, is not significantly lower than it was when the forecast was made a year ago. So we've had 8 or 9 years now of, in year X, I forecast X plus 1 is going to be real good. And then in year X plus 1, I have to say it isn't. Okay, so we've had constant downward revisions. And this is the first year, I think, where we haven't had that. So maybe this is just the beginnings of some sustained good news. It is possible. And of course, if you do get a sustained, relatively rapid growth, and the debt ratios start going down, then I think all of those asset prices that you look at now as being pretty rich, the reaction might well be, they're a bit rich, but the underlying fundamentals are better, and so it's okay. Okay? So that's one story that you could tell. But there's two things that worry me about that story, and that's why I think we're just going to have to wait and see. First thing is, of course, inflation. And if the story is one of we've got sustained growth coming down the line here, but Germany, Japan, the United States, and a number of other countries are already pretty close to full employment, then even if we haven't seen the inflationary danger, there's always the possibility that it will erupt. I think the policymakers, for all sorts of reasons, have got a bias towards keeping things easier than, the type of error that they will fall prey to will be one of too easy, too long, as opposed to the other way around. Not least because if they raise rates or whatever, and that the economy falls back in consequence, central bankers are going to get 100% of the blame, and they know it. Okay, so they're going to be pretty worried about that because they're human like everybody else.
So in terms of the inflationary pressures, how do you, I keep hearing from some smart people who say, debt levels are too high and demographics going the wrong direction to ever see another sustained rise in inflation. How do you think about that?
Well, I actually think that demographics are moving in the direction of more inflation because it's just a reversal of the process that I talked about before. That, we're now, China's got declining working age population, Japan's got declining total population, Korea's same situation, the US it's again sort of all of the demographics, the baby boom stuff and the international stuff, I think they're all working in the direction of negative supply side shock. And what that would contribute to would be more inflation going forward, not less. The caveat to that, and I say the whole thing is totally uncertain here. The caveat is that maybe we'll get productivity gains of a sort that will offset that. And, there are guys, for example, like Brinfelson and McPhee. You wrote that book called The Second Machine Age. You know that book?
I have not seen that one, no. Okay,
there's two guys out of MIT, actually. It's a very thoughtful book. But it totally flies in the face of Bob Gordon's suggestion that productivity, the big increases in productivity are behind us. We'll never see them again. These guys basically say we're just on the cusp of huge productivity increases. Now, I won't get into this now, but that's the first half of their book. Second half of the book is all about winner take all and income distribution and jobs and middle class jobs But the central point of productivity increases is it could offset the demographics. And frankly, I don't think anybody in the whole world knows what the relative force of those two things will be. But as I look forward, it seems to me that we'll see, what's the word? We'll see these two forces, demographics, more inflation, productivity, less inflation, fighting it out, and we won't know until we see it happen. What I would say, however, is that if the central banks, during the whole period of time that we don't see the inflation rise, the central banks keep on gunning the monetary engines, then in the end, they will create the inflation. But in the process, I suspect they'll also have created an awful lot more of the imbalances that I was just talking about. So I think in the end, this good news story, even if the inflation rate stays low, you could get yourself into other problems. And I guess that sort of brings me back to when I was saying, here's the good news story, but what could go wrong? One of them is inflation. But that's not the only thing that could go wrong. Even suppose we don't get a big increase in inflation. As I suggested, there are so many imbalances out there and so many sources of concern that as and when the central bankers eventually have to tighten, the response of the financial markets could actually be pretty disorderly. And that's the thing, it seems to me, that I think the Fed's got this in the back of their mind too. You read their stuff and they're so cautious and so they don't mention the financial thing, but it's got to be there in the back of their minds that things are so far away from normal, particularly all these asset prices and the degree of not the degree, so much degree of leverage, but the growth of these cov-lite loans now, and in the United States in particular, people worried about subprime car loans and consumer credit and student loans, and there's a lot of worry that there's vulnerabilities there, and I think when the rates do start to move up in any kind of serious way, the markets, there could be a lot of people heading for the exits at the same time. And all of those people that are smarter than the other people, and that's everybody, they're all in the game because they all think they can get out first. And so I think that point where you get a good news story and the Fed and everybody else then says we have to start to tighten up, that's going to be a very dangerous time. And it could work out okay, but I think there's a very reasonable chance that the markets will overreact. And if that's the case, then we'll be back into recession again. And we'll be in a recession with all of that debt buildup. And then where you go from here is anybody's guess. And that's the good news story. So you can tell a story, but there's a lot of risks associated with it.
Right.
The bad news story, of course, is that Yeah, the forecast for 2017 has been revised up for the first time in 9 years, but wait another quarter and it gets revised back down again. And it turns out that it's nothing more than, a false signal, that in fact the global economy is as sluggish as ever. And if that's the case, then all of that, the wishful thinking about equity prices and high yield spreads all being justified by the circumstances, people will have to go back and think again. The extend and pretend will have to come to a halt. And then you're back to the first scenario if some of the risks materialize. So I think this thing, it is possible that this thing could end happily and in a measured, orderly way. But there's I think it's a pretty narrow doorway. That's personally my own feeling about it. It's possible, but it's a pretty narrow doorway.
Gotcha. They're trying to thread a needle where by scaling back these emergency experimental policies after a decade without undoing the good effects that they created. And really the main effect that I see from quantitative easing is they were able to create a wealth effect by boosting financial prices of financial assets, although it probably didn't have the economic impact that they hoped. It only stands to reason that if you unwind those policies, you risk unwinding those effects as well.
They can't have it both ways. I mean, on the one hand, the central banks are constantly claiming that what they've done has been a very positive stimulus to aggregate demand. The ECB has been a bit more clever. I mean, they mostly have been talking about improving the transmission mechanism, whereas I think the Fed and the Bank of Japan, it's been more blatantly, we've tried to increase aggregate demand and it's worked. But you're absolutely right. I mean, if what you see is because of QE, and then they decide to unwind QE, well, then I would expect to find a reversal of what happened earlier on, which is not good for aggregate demand.
There's a book I read in the last couple of years, and I really thought it was fascinating. And I've never been a big history nut, but I've really gotten into it recently. It was Lords of Finance, and there's a great quote in there, I think, from Montague Norman. It says, "As I look back, it now seems that with all the thought and work and good intentions which we provided, we achieved absolutely nothing. Nothing that I did and very little that old Ben did internationally produced any good effect, or indeed any effect at all, except that we collected money from a lot of poor devils and gave it over to the four winds." And when I read that, I thought about a lot of the quantitative easing that's been done, and mainly in terms of corporate stock buybacks. There's a lot of money that was borrowed over the last 10 years and used to just buy back equities and retire them. And to me, giving money over to the four winds sounds a lot like that. Do you feel like history is rhyming today with that earlier period?
Well, I do. I mean, I think the funny thing about it, my PhD supervisor actually was Victor Morgan, who was actually an economic historian. And so I've had an interest in economic history for a long period of time. And I've got a folder here. I know I shouldn't keep paper, but I've got a folder here that must be 9 inches thick about previous crises and the characteristics and whatever. Most of the stuff, unfortunately, written after the crisis hit, But, I think, as they say, history... Mark Twain, isn't it? History doesn't rhyme, but it doesn't repeat itself, but it rhymes.
Exactly.
And I first caught on to this, I think. I was very interested in the Japanese experience. And once you started thinking seriously about that, it started to look sort of very much like the 1930s. And then I went back and read a piece by Joseph Schumpeter that was written in 1934, I think, in which he looks back to the big recessions of 1874 and 1825. And what comes out of it is seen it, done it. It's big run-up, speculation of various sorts. And in the end, the whole thing collapses. And John Kenneth Galbraith, I can't find the quote right at the moment, but in one of his books, he talks about new financial instruments, okay? It's the same sort of thing with CDOs and CDO squareds and all that kind of stuff. But in the 1930s, it was consumer credit, and in the 1870s, it was credit to the railways and blah, blah, blah. So every one of these things, every one of these big financial crises has had an element of new instruments, okay? And the policymakers always like to emphasize the role played by these new instruments because it gets them off the hook. Because they can then say, well, look at this, was a totally new development. Nobody had ever seen CDOs before. How could you expect me to understand the full implications, et cetera, et cetera?
Right.
But what John Kenneth Galbraith says that this is the case every time there's a big crisis. And what nobody ever asks about is the underlying speculation and excessive credit expansion that led to the boom in the first place. And this is what I've called earlier on in various speeches and stuff, the difference between the school of what is the same, i.e. credit and speculation, and the school of what is different, okay? Well, it's all these new instruments. And I think what you see throughout history is just a repeat of these processes. And of course, the classic works there, I guess, are Carmen Reinhardt and Ken Rogoff, This Time is Different. Schulerich and Taylor have written a lot of stuff about this, big historical databases. And yeah, there's a lot of it. And an underlying theme as well is that property is right at the heart of it. If you're looking for a magic bullet, that sort of, to the extent that there's a magic bullet in these things, I shouldn't say magic bullet. The thing that really does you harm is speculation on property, and property is collateral, and as what's his name, Adair Turner points out, a lot of the property stuff doesn't even have to do with new property. It just has to do with credit extended for the purchases of old properties, driving up their prices. Then you say to yourself, that's a pretty weird way to run a system. But I get you on to much more revolutionary stuff, but whether we need narrow money, back to the Chicago school of the 1930s. I should put in a plug for a book. Two young guys from Zurich.
Yeah, please do.
They've written a book. It's a pseudonym. It's called, the author is Jonathan Macmillan, and the book is called The End of Banking. And what they mean by that is the end of a system in which banks can create credit by simply writing up both sides of the balance sheet, which is what they do, right? Mm-hmm. And so it's sort of Chicago school, but the fundamental problem with the Chicago school was that they really didn't pay any attention to the fact that people could invent money in different ways. Shadow banking, okay, which is basically what happened the last time around. And this book it makes a very sort of persuasive case for how you can use fintech, how you can put fintech together with narrow banking to get a much more sensible financial system than the one we have at the moment. It's very interesting stuff.
Yeah, thanks for the recommendation. I'll have to check that out. I got one last question for you. I'm very curious to know about, obviously, we've discussed the unintended or consequences of experimental discretionary monetary policy. And you brought up earlier in the conversation about central bank independence. What are your thoughts on more of a rules-based policy, something along the lines of a Taylor rule for central banks?
Well, I guess I would say, and again, I'm sort of torn about this. I'm against it in any kind of narrow rule sense, like a Taylor rule. Basically, because I believe that the world is such a complex and adaptive place. And this goes back to the beginnings of our conversation, with all of the things that the Bank of Canada tried to do. This is our rule, this is what we're going to do, and we came a cropper in all of them. So I think there's a considerable degree of discretion that is required of any central bank in the conduct of policy. Having said that, it does seem to me that there ought to be much more emphasis in terms of, there ought to be much more emphasis on the potential unexpected consequences of what central banks do. Okay, so this is sort of putting constraints on them, but in a rather different way. Like, I think the difference, for example, if you think about how radical the policies conducted have been, and the potential radical implications, okay, of the sort that we were talking about, you would have thought that there would have had to be some very significant, almost proofs that those side effects were not there. And the example that I use is think about the FDA. If you want to bring in a new drug, okay, not only do you have to prove that it works, but you have to prove through diligent attention and experimentation, all the rest of it, that there aren't any significant side effects. And yet these policies, these monetary policies, we've proceeded on the basis of full speed ahead and damn the torpedoes, without any serious consideration even of the possible side effects. And I think that's wrong. But maybe that's just sort of my basic conservative nature, But it is in a sense, it's back to Hayek, I guess, which is, the concept that even institutions, the basic way that people do things, they've been brought in for a purpose. They've evolved over time to suit a purpose, and that to just simply sweep them away without due consideration is not very sensible. But maybe that's just me, sort of in my rather, the older I get, the more fundamentally conservative I get, where it just says, but there must be some good reason for this, in an evolutionary context. So I wouldn't go for a detailed rule. I think central bankers need a lot of discretion, particularly as the world changes. But I think entertaining more seriously the idea of there could be unintended and undesired consequences, and taking steps to ensure it doesn't happen, that ought to be much more part of the analytical methodology that would support doing what they do.
Perhaps an additional mandate of first do no harm.
Well, I've used that before too. Remember Mervyn King at one point used that quote of Keynes that he hoped that eventually that central bankers would be thought about as just ordinary humdrum people like dentists. Okay. And I can remember when he said that, I'm with you. I was going one step further. No, not dentists, doctors. Above all, do no harm.
Right. Well, that's perfect. Thank you so much for your time today, Bill. I've really enjoyed the conversation. How can people who want to keep up with your ideas and your writing, where can they find you?
Oh, it's on I've got a website. It's in the process of being redone, but it's still up. And it's www.williamwhite, one word.
WilliamWhite.ca. Okay, yeah, that's
.ca. That's CA for Canada.
So I really want to encourage everyone to go check out Bill's website. He's got a ton of great material there, including the speech that I referenced in the intro. As always, I'll put up links to that speech and to Bill's website in a post at thefelderreport.com. And that does it for another episode of Super Investors in the Art of Worldly Wisdom. Thank you very much for listening. If you're enjoying this podcast, please leave me a review on iTunes. And until next time, buy low, sell high.
Looking good, Billy Ray!
Feeling good, Lewis!
Man looks in the abyss. There's nothing staring back at him. At that moment, man finds his character. And that is what keeps him out of the abyss.